Hello, ladies and gentlemen, and as usual, we start with the bond market in our review of this week. Here we are with the 5-year note. Well, who would have thought that in a week when the stock market did absolutely nothing, the 5-year note ended absolutely at the low yield. So it's absolutely incredible what this market is doing. It is doing exactly the opposite of what people expect. Another few days here and we will be going down towards the moving average and certainly filling this gap around 283. This is a turn up for the books because everybody is expecting higher yields, and in fact they're getting lower yields now, and this is actually what is making the stock market as resilient as it is. Had these yields remained up here, the stock market would probably be well below 2700 again. But it is the bond market, and not only the 5-year note, but if we look at the 10-year note, much the same picture. But as I told you, the yield curve now is beginning to steepen out, and this picture is much less bullish in terms of price and bearish in terms of yield than the 5-year note. And if we look at the 30-year and we in fact look at TLT, it's beautifully coming back up to the level which is the level of all levels, which is 115.25, let's call it. So 115.25 is the level that you want to buy puts in TLT and see what happens. Because if we, or even straddles, because if we start moving towards 117, 118, that is going to be a huge change and something which is going to have very large impacts on everything. The only reason why yields would fall so rapidly is a conclusion that growth is going to be very anemic next year, and that the increase in the forward earnings that the market is discounting at the moment is going to be nowhere near as good. To me, this is going to be bearish for the stock market, or if you look at it, we could be returning to a period like 2015, 2016, when for 2 years the stock market did absolutely nothing, and we shall look at that in a moment. And actually it was yields which outperformed the stock market, even though the stock market was nominally up very slightly. And that is what our risk parameters could be indicating, because the risk parameters are very, very negative still, and they are still saying that the better place to invest your money is bonds rather than equities. What about European bonds? Well, this is the Bund, and it's a weekly chart, and as you can see, it is doing almost nothing. It is coming back down towards the 28 basis point level. Who would have thought that this was going to happen? The market hasn't been much better than this just about all year. This is where we started 2018, and as you can see, we are now lower in terms of yield than we started the year. So in Europe, had you been invested in bonds, it would have definitely paid off, because we are much lower in terms of equities than we are in bonds. And much the same thing looks to me like it's going to happen in the United States at some stage. This is an hourly chart of the equities. Nothing very much is going to happen quickly in equity land. 2725, which is the title of the of this presentation, is actually, for those who have asked me, the point of control for the whole of 2018, i.e. it is where most of the volume has been trading. 2725. Above 2725 it's slightly bullish, below 2725 it's slightly bearish. But if you look at actually what we've done all week, is we've come down hard, we've filled all the gaps on the downside, and then the market just started going higher again, basically retracing. We have all these moving averages around the 2750 area. That is going to be a very, very tough area to break. If we do break it, we're definitely going up, and we're going up certainly to fill this gap all the way up to 2798 in the XPX. So that is what is more likely to happen than not. While here, if we have a look, what could happen if we fail? Well, if we fail, we're going to go down and make new lows and probably trade, just take out this low, trade 2660, and then go back up to the moving averages. So really the trading range that I can give you for next week is, if we fail here, we go down to 2660. And if we don't fail, if we take out and close above 2750, we're going to go slowly back up to 2798, 2800. It's a holiday shortened week. I don't expect very much to happen. I would have thought we closed within 1% of where we closed on Friday. So it will be it will not be an exciting week. The exciting part is really what's happening to NQ, and which is what we've been warning about for such a long time. And that is that it just can't rally. This is a 10-minute chart. It's done an inverse head and shoulders. I would not be surprised now if it went all the way back up to 7,124. Slowly over the course of 3 or 4 days. Certainly this first gap should get filled around the 7,030. But if you think about the loss of leadership that the NQ presents, it is just amazing. We had weeks and weeks and weeks of NQ making new highs, and now it has been in a 200 to 300 point range for the best part of 2 weeks. This is not leadership. This is something that happens when markets lose leadership and just basically meander. If NQ just meanders for the next couple of weeks during the best part of the year, what is it going to do when real risk-off strikes after the new year? And we've had, the Santa rally and the January effect and all that. To me, unless we're well above 7,200, well above it, and let's have a look at a weekly chart, we are in big trouble. And here is the weekly chart. And this is really why I keep on selling something like the 69,000 straddle when they were trading it like at over 300 points, simply because we are coming down this Bollinger Band. The market spikes the Bollinger Band, comes back in. Spikes the Bollinger Band, comes back in. Now it wouldn't really surprise me if we traded 7,130 over the course of the next few days. And then we are opening up these Bollinger Bands. So 5, 6, 7 weeks of trading sideways, and then we are ready for the big move down. This level is going to be very, very important, 7,179. I'm going to mark it here, and that's the level that I want to have some sort of a position at, 7,181. The market seems to have, every time it's got anywhere near it, it's rejected it. This moving average is still going up, so it might be 7,230. Who cares? For 50 ticks. We are at this kind of level between where we were, 7,181, and let's call it here 7,266. That is our shorting area. That is where we want to get some good puts on. Volatility is actually predicting this market beautifully. if we actually enlarge this, you can see what the market did. It went here, it filled the gap that it had left, it's come off, and now actually it's broken through the very important 1950 level today. We did sell volatility, but not in huge size. And now, at a guess, it's going to come down to 1630. 1630, if you remember, was the level that we bought it at. And 1630 is most probably the level that it will trade sometime next week, and that is going to probably equate with 2800 in S&Ps. So we're looking for 2800 is the level, and we're looking for 1630. At 1630, rinse and repeat, we buy volatility again. I've put these two charts together. That's the S&Ps with a red candle for the weekly. So we basically came down to the weekly level, and now we're probably going to go and touch here this level 2818 next week. And this is emerging markets with a green candle. I think what is happening is that emerging markets are now going to are leading the way up and will trade somewhere around the 44 area, 43 to 44 area, before they're exhausted, and this will probably enable the S&Ps to trade 2800, or even that level that we said 2861, where we want to get massively short. So we have a sideways pattern, probably some sort of a wedge which will develop here in the S&Ps, while this market retraces probably the 0.382. And if we have a look at where that might be, here we are. 42.90 would be a nice level. Maybe even the 0.50 at 44.50. 42.90 to 44.50 in emerging markets would be really nice over the course of the next 3 or 4 weeks, while we do some kind of a wedge and hopefully trade 28.61, where we really want to be positioned short. For those of you that look at commodities, I wanted to draw your attention to all these red bars in commodities. It is, to me, likely this is a very good channel which has lasted for many years. It's very likely that we will trade back up towards at least 1670 in the commodities as a reaction before we break down. But the fact that commodities are breaking down is certainly not a good reason to go long of equities, is it? So, because if commodities are getting sold to hell, it's quite obvious that something is wrong with global growth. And to me, what is happening in the stock market has nothing to do with Brexit. I mean, Brexit doesn't help. But it's all about the market trying to decide whether we are in a slower growth phase, and whether the Fed is going to be stopping their rate hikes. The bond market is telling you yes, and that is slightly inflationary. The bond market in the 5 years is actually telling you that the tightening bias is over. We were last here in September, beginning of September, before the Fed hiked, and now we're looking for a Fed rate hike when in December, and we are looking for another one in January, February or March. The bond market is saying, no, you're not going to get it. You're not going to get it. Look at these green bars. 1, 2, 3, 4, 5, 6, 7 green bars on the trot. Okay, we're probably going to get a couple of red ones, but 7 green bars on the trot we haven't had, well, since this level. And look what we did back in this would have been June of this year. To me, this is significant, coupled with DBC. When we get this rally towards 17, we definitely want to see if we can get some puts on board just to see if it breaks this channel, because if it breaks this channel, it's going to be very, very interesting. Let's get a weekly chart up. You see how oversold it is. It would not surprise to see a 2 to 3 week rally, but if we start breaking through these levels, we've got nothing underneath, absolutely nothing, all the way to 13, and that's a 20% move in commodities, which is going to be absolutely incredible. So really we are looking for this move back up to 17, buy some puts and see what happens. As to the dollar, it's going to be very, very frustrating. It is basically just coming back to the 96.50 level all the time. It will now probably come back all the way down to 95.80, which is the next level we want to buy. Still think that slowly we get up to 99. Whether it's by the end of this year or beginning of next, I don't know, but at some stage the dollar is going to go higher, simply because there is a dearth of dollars in the world, and also because the yield curve is steepening. I just can't see the attraction of holding any other currency but the dollar and some sterling, but that's just me. I'm not a great foreign exchange trader, but certainly with this kind of a picture, to me, unless we start breaking below 95.07, this is still a very bullish chart, and one which in fullness of time will be going towards par. I just wanted to show you this spread, which is basically the semiconductors over the yen. You remember how it's given this death cross here, 200-day moving average, 50-day moving average. We can enlarge it very quickly, and it's basically that the 200-day moving average is rolling over. The longer it stays down here, the more bearish it is. As I said, it has room for small rallies. That's why I think the Nasdaq cannot have a big rally. It can have a 2% rally, but that's about it. That is all it can do, because it's going to get stopped by these moving averages. And if we actually zoom out, you'll see how reminiscent this period is to this period, which is 2015, 2016. 2015, 2016, the market did nothing, went sideways. If we have a look at a chart of NQ for that period, 2015, 2016, it just did nothing, and then it broke higher. I think this is probably what we're going to do, but this time I don't think we're going to go break higher. I think we're going to trade quite a bit lower, probably way below this 6,200 level, and I would have thought that we are going to retrace a good deal of this whole rally by actually even coming along and touching this trend line at some stage. It might be 5,700, 5,800, something like that. I think we are in the first stage of risk off, and we break for a last wave down towards that level. That's my big picture first idea. The biases haven't changed very much. I want to remind you about that 115.25 level in TLT, which I mentioned earlier. You can go back and have a look at it. That's probably a great level to buy some straddles. Volatility should be cheap, and should be a great level. Bunds and bobble, untradable. It doesn't make sense, because rates should be heading up worldwide, and they're not. Now that is what is really interesting, because we can't really keep that there because they're not going up, but Germany is still untradable, simply because you never know what the Italian market is going to do. The Italian market has, a nightmare, and we go up like crazy. that is very, very, very difficult. Here we know really 26.25 is times 15 Blue Angel, but we can actually bring that up even to 26.65. That is a level which should really hold very, very easily next week. And 2800 is the times 16 Blue Angel, and as we said, that is more than likely to trade next week. But 28.61 is still the level that we think that the market has a chance of really having a nightmare from. You know my view about NQ. It's lost leadership. Something which loses leadership eventually breaks down, and I will be looking for levels, and I showed you in the video, for levels to sell it. VX, here we are, only closed above 21, indicate immediate danger. We never got any. Now 1630 is the level in VX that we want to buy. We are not going to get to 24. I don't think we're even going to get to 21. So really 1630 is the level to play a bounce. That should coincide with 2800 in the SPOOs. Don't forget this market is leading. VX broke, indicating that we're going up towards 2800 next week. Hopefully that will actually give us the 11,800 level for the DAX. That is still the level that I want to buy puts at. I don't want to touch the European markets until we get to 11,800. DX, complete pain in the ass. It just goes up and down from 96.50. This is still going to be the key level. If it trades 93.63, then we are completely wrong in thinking that the dollar is going to go higher. And we still think that this very much applies. Stay away from high beta. You're going to get days when high beta outperforms, and those are great days to put on positions which are basically long DJI and Nikkei and short something like NQ. So to me, those are stick with quality. I know that I've said next week we go up to 2800. That is like 2%. Great, but the big danger is to the downside. It's no longer to the upside, it's the downside. Thank you very much indeed. I'm now off to London to see my new grandchild, and I'll tweet you on Tuesday because I'll be flying back on Monday. Thank you very much indeed. Have a great weekend.